Hi and welcome to Swissquote's daily market talk. It's Thursday, April 10th. Donald Trump rolls back tariffs for countries that haven't retaliated yet and for Europe. So the answer was the sovereign bond markets, guys. It is the flash sell-off of last couple of days across the US Treasury bonds that made Donald Trump take a step back from his tariffs. He didn't care about the equity market sell-off. He couldn't care less about the global risk sell-off. He was certainly even happy to see the Chinese assets and crude oil tank, but the fire sale of the US Treasuries in a couple of days increased the pressure on Donald Trump to an extent that it apparently became unbearable even for Trump to continue with this tariff stupidity. And I'm really being careful with my words. So Trump announced that there would be a 90-day pause for countries that have not retaliated just yet. That called him actually, while stepping up pressure for China. The Chinese products will actually be taxed at 125%, as China also announced to tax their US imports at 84% earlier yesterday. Now, funny enough, it looks like the Europeans, who actually did retaliate, will be benefiting from that 90-day ceasefire on the tariff war. This being said, the universal 10% tariffs will still remain in place, and the war is not over just yet. We will be talking about this and only probably about this for the next 90 days and 90 nights and probably a few more years. Now, the market's reaction, the global market's reaction was incredible yesterday. It was incredible. I've never seen anything like that. First, the pressure on US Treasuries eased happily. The US 10-year yield came down to below 4.30% from above 4.5% reached yesterday morning. Then the 30-year yield came down to below 4.70% this morning from above 5% reached yesterday morning. That's a good thing, I guess. Then the US equities recorded their best jump since 2009 global financial crisis and their fifth biggest rebound in history. The S&P 500 jumped 9.5%. Nasdaq 100 soared 12%. The Dow Jones nearly 8%. And wait, I'm not done. Nvidia recovered more than 18% of its value yesterday. Apple jumped 15% from a year low level and Amazon by 12%. Then the US energy stocks rebounded almost 8% as crude oil jumped by a similar amount. Even Nasdaq's Golden Dragon China index was up by around 4.50%. So those are obviously crazy. Those are wild moves across the global financial markets. The European stock futures are up by more than 8% this morning before the open, although the US futures are taking a breather this morning with slight retreats that we see across the board. Investors are obviously happy that a 90-day pause will give countries enough time to negotiate with the US and eventually to reorganize their supply chains and businesses to temper the violence of the US tariff shock. So that is fundamentally positive news, and that regardless of whether the US will go ahead with these tariffs or not in 90 days from now. I think that having time to put together a B plan is great thing, but I wouldn't uncork the champagne just yet. Yes, I know, because you see the broad damage of the tariff uncertainty on businesses before the tariffs went live. In the sense, well, Delta Airlines, for example, lowered its earnings guidance yesterday, pointing at global trade tensions, you guessed it, with people actually being detained by the United States Customs randomly these days. It's not the best time to be a tourist in America. I guess we like Italy better right now. Then Amazon actually canceled its orders for products that come from China and other Asian nations like Vietnam, for example, including beach chairs, I heard. Not because obviously that the Americans will be going back to work and get their manufacturing jobs back and will have less time to spend on the beach as a result, but because they are trying to cut their exposure to China and other Asian nations that have been hit heavily by tariffs. Walmart, on the other hand, kept its own full-year forecast unchanged. The company is confident that the turmoil of the moment will help their low prices attract more people, as people will be more miserable with higher prices elsewhere. Now, it's needless to remind everyone still that China remains one of the biggest markets for companies like Apple and Nike. They export a lot of rare earth metals, a lot of commodities, and the war on that front continues at full speed and tensions even keep rising. So we do have a relief, yes, but still be cautious. The US earnings season kicks off tomorrow with US big banks due to announce their earnings, and the earnings season could actually give us hints on how companies plan to adapt to Trump-induced volatility and uncertainty. I believe that this earnings season will be more about forecasts and guidance than actual numbers, to be honest with you. It is a certain thing that the forecast will be lowered for this year, unless you are a business that flourishes in a weak economic environment like Walmart or Dollar General, for example. But how low the forecast will go is yet to be seen, and how low they will be compared with what's already been priced in during the latest market sell-off will be obviously important. Good news here is that the market pessimism went quite far during the latest sell-off to leave some room for recovery. Broadly speaking, though, it's impossible to predict what will happen next. I mean, what will happen the next minute, right? Not the next month, next minute. Because US went completely crazy. I believe Donald Trump will go down in history as the most unpredictable US president at best, and at worst as the one who managed to dismantle the very idea of American exceptionalism. What a U-turn from a year earlier, right? After 2 magnificent years of AI shine for the US companies. Unbelievable. But anyway, uncertainties will obviously persist, but yesterday's rebound does have quite a solid ground still, as I said before. Therefore, we could see the rebound extend if Donald Trump just can keep quiet for a few days and let the markets digest the latest uncertainty and volatility, and just watch the earnings and industries' reaction to the latest trading and world environment. On the economic data front, investors will also be watching the US CPI update with a lighter heart today. Headline inflation in the United States is expected to have eased from 2.8% to 2.5% last month, probably thanks to lower energy prices and also lower egg prices, while core inflation is expected to remain steady near the 3% mark. That's still above the Fed's 2% target. Now, the Fed has not said much during the latest market sell-off, other than the US monetary policy is probably in a good place faced with the increasing growth and inflation uncertainties. Right now, the US recession bets may have been scaled back yesterday, especially after the 90-day pause, but they still remain significantly higher than before Donald Trump took office. And if inflation in the US remains in check, the Fed should cut the interest rates. That is a no-brainer. So let's see where inflation is headed next. The Fed is not expected to do much in May, but bets that the Fed could cut by 50 basis points in the June meeting have risen to above 10%. Now, as little sense as it made to cut the interest rates by 50 basis points last September, it makes just as much sense now if inflation remains under control. So if inflation is in check and economic data comes in weak, the dovish Federal Reserve expectations could keep appetite in risky assets reasonably strong. I say reasonably strong because the risk still persists and they are very unpredictable. For China, though, it's still complicated. Trump's nemesis doesn't benefit from that 90-day pause to tariffs, and inflation data there in China shows that the deflationary pressures remain in play, and that despite the Chinese government's efforts to boost growth and inflation in China. But hey, that weakness is actually needed for China to boost its supportive measures. So China remains, I think, an interesting market for those investors who are betting that the waning US exceptionalism trade that will remain in place even with that 90-day truce could eventually benefit to China. So it could be interesting to look for diversification opportunities, though keeping in mind that the risks remain elevated. Now, this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our WhatsApp, Threads, Telegram, and Blue Sky channels for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.